All right, let's dive deep today. We're going way past just glancing at a company's financials. This is about really understanding a company's financial health, not just the numbers they show us. We're talking financial statement analysis. And we want to equip you to ask the really tough questions.
Yeah, think of it as like building your financial intuition.
Yeah.
Being able to spot those red flags. And we'll be drawing insights from a fantastic book, Financial Statement Analysis, by Martin Fridson and Fernando Alvarez.
Now, these authors, they don't sugarcoat anything. They really emphasize a skeptical approach, which I love. It's not just theory. It's about looking at these reports with a critical eye and understanding that the real world, well, it's not always as clean as a textbook example.
Absolutely. You got to be ready to get your hands dirty. And that's what this deep dive is all about. We're going to explore the limitations and, let's be honest, the potential for manipulation within these financial reports.
Exactly. So you can walk into any meeting, any situation, armed with the knowledge to uncover those valuable insights, the ones that others might miss. So let's jump right in. The authors start by discussing what they call the adversarial nature of financial reporting. What's that all about?
Well, it's this inherent tension. Financial reporting, it's not always a perfect mirror of reality because you've got to consider management has their own incentives, bonuses tied to performance, pressure to keep that stock price up, and that can lead to a situation where the story they're telling might be, well, let's just say selectively optimistic.
Right, so it's not just about the numbers themselves, but the motivations behind how those numbers are presented. The book brings up this idea of small profits and big baths. Can you unpack that for us?
Sure. Big bath. That's a strategy where a company takes a whole bunch of negative charges all at once, often when they've had a bad year or maybe there's a new management team coming in. Kind of like cleaning house.
Yeah.
Make the future look even brighter by comparison. And on flip side, small profits that might be about understating profits when things are good to create a sort of earnings cushion for the future. It's about managing the story, creating a smooth upward trend.
Ah, so you're saying they might be trying to manipulate not just the current picture, but the future comparisons as well.
Right, it's about controlling the narrative. And then there's this corporate credibility gap that the book talks about. It's the difference between management's projections and what actually ends up happening. How do these reporting practices impact that gap?
Yeah, that gap can be a real headache for investors who rely on those projections.
Well, think about it. More flexible reporting practices, where you kind of stretch the rules a bit, it makes it easier for companies to close that gap, at least on paper. They paint a rosier picture in their reports to keep investors believing in the growth story, even when the reality might be slowing down. Exhibit 1.1 in the book shows how this gap can evolve over time.
So it's all about keeping that growth story alive, even when the numbers might not fully support it. Speaking of growth, the authors bring up a really simple but crucial point about the math behind it.
Oh, absolutely. The power of a growing base. I mean, a 40% increase on 10 million in sales, that's adding another 4 million units. But try getting that same 40% growth when you're already selling, say, 60 million units. That's a massive jump.
So that consistent high growth rate, it's just not sustainable forever. You're eventually going to hit a ceiling.
Right. You can't defy the laws of physics, or in this case, the laws of economics. And yet you see companies reassuring investors with these optimistic narratives. New products are going to reignite growth. Or framing any dip as just a temporary hiccup. Our year-over-year comparisons were distorted, as Exhibit 1.2 puts it.
It's like that saying, hope springs eternal. People want to believe in the positive story. But we, as savvy listeners, need to keep that critical eye, right?
Exactly. Don't just buy into the hype. Ask yourself, is this a temporary blip or the start of a bigger slowdown they're trying to downplay? It's all about exercising independent judgment, especially when you're looking at potential risks.
And one area where that judgment is absolutely crucial, according to the book, is with contingent liabilities, those potential future obligations, often from lawsuits, like the examples they give: asbestos claims, silicone gel breast implant litigation, environmental hazards.
It's so easy to get lost in the numbers and overlook these massive looming legal risks. And often companies, they just brush them off, give these very matter-of-fact responses to questions about these potentially huge claims.
It's almost like they're saying, nothing to see here, move along. But the authors really challenge us to consider the company's perspective. Why might they be downplaying those risks?
Well, think about it. Executives often have a personal stake in a high stock price. Their compensation, their stock options, all tied to it. So, admitting a big legal problem,
That
that could send the stock plummeting.
Right, so there's a huge incentive to keep things looking good.
Exactly. Plus, they're in the middle of a legal battle. Admitting the plaintiffs might have a point weakens their position. And then there's maybe even an element of, I don't know, psychological denial. It's tough to accept that your successful company could be brought down by something outside your control.
It's like the classic "it can't happen to me" syndrome. So what's the takeaway for us when we see these situations?
Don't just take the company's word for it. Look for other perspectives. If there's a big lawsuit, see what the plaintiffs are saying. Their view, while obviously biased, might reveal weaknesses in the company's arguments. It's about getting the full picture.
That's great advice. Now, the book then moves into a very practical area, credit analysis. In the inherent tension between maximizing profits and maximizing sales, especially when it comes to extending credit to customers. Exhibit 1.3, with its cutoff points, really illustrates this.
Yeah, in credit analysis, you're not aiming for zero defaults. To truly maximize profits, you have to accept some level of bad debt.
So it's about finding that sweet spot.
Right. You'll inevitably reject some customers who would have paid, and accepting some riskier accounts can actually boost sales and profits overall, up to a point, of course. But the danger is when maximizing sales becomes more important than profitability.
I can see how that could happen, especially if salespeople are incentivized by commissions. They might pressure credit analysts to approve anyone and everyone.
Exactly. That misalignment of incentives can lead to big problems down the road. And the authors provide some great historical context with those waves of defaults, like the high-yield bond market troubles in the late 80s and the dot-com bust in the early 2000s. What can we learn from those?
Yeah, those are some turbulent times. What are the key lessons there?
It's fascinating. During boom times, organizations sometimes convince themselves that the old rules no longer apply. In the late 80s, it was about the supposed value of off-balance sheet assets. In 2001, it was all about the unlimited potential of new tech, even for companies with no real track record.
So it's easy to get swept up in the euphoria and forget the fundamentals.
Right. And those periods serve as a stark reminder of what can happen when you abandon sound financial analysis.
It shows that even when things are changing rapidly, those core financial principles, they still matter. The book also digs into this idea that a corporation is more than just a simple profit-maximizing machine.
Yeah, it's not just about maximizing shareholder value at all costs. It's more accurate to think of a corporation as this collection of individuals, each with their own motivations and priorities. Corporate decisions, they're not always driven by what's best for the bottom line in the short term.
So it's a much more nuanced picture than just pure profit maximization.
Yeah.
And that complexity even extends to valuing things like proven crude oil reserves. You'd think that would be straightforward, but
It's surprisingly complex. You see, there are market prices for reserves in the ground, but those are based on estimates of future production. And even with all the technology we have, these estimates still rely heavily on expert judgment. Wells can underperform, and you can't really pin down a single true value. Accountants have to rely on these informed guesses, and there can be huge disagreements, even among the experts.
that's a great reminder that even with something seemingly as objective as oil reserves, there's still a degree of subjectivity involved. And this brings us back to the balance sheet, and understanding that those figures are based on GAAP, generally accepted accounting principles, which might not always reflect the actual economic worth of the assets.
Absolutely. GAAP is necessary, but it's based on historical costs and accounting conventions. The book points out that bond rating agencies have been really good at looking beyond the accounting folderol to assess a company's true economic strength.
So they're not just blindly following the rules, but trying to understand the real substance behind the numbers.
Right. And the multi-billion-dollar goodwill write-offs we saw around 2001, that's a prime example. The rating agencies, they didn't automatically see these write-downs as bad for lenders. While the reported assets to liabilities ratio might have gone down, the tangible assets to liabilities ratio, which excludes goodwill, often stayed pretty stable. They kept a skeptical view of goodwill even during the new economy hype. And in hindsight, they were spot on.
It's like they were saying, let's not get carried away with these intangible assets. Now, the book uses scenarios I and II to show how goodwill is created in acquisitions and its impact on those balance sheet ratios. Can you walk us through the takeaway there?
Sure. In scenario Y, even when the buyer pays a premium, the goodwill created doesn't drastically change the total assets to liabilities ratio, so they can acquire a company with weaker debt without their own leverage looking much worse. Scenario 2 shows that even with inflated market values, those asset to liability ratios based on historical cost, they tend to be more stable. And that's reassuring to those conservative bond buyers. So a big goodwill figure isn't necessarily a sign of strength. We've got to look deeper at those tangible assets.
Right. It's about seeing through the accounting smoke and mirrors. Another tool companies use to influence their stock price, the book mentions, is the leveraged recapitalization, which can even fend off hostile takeovers, as shown in Exhibit 2.2. What's the basic idea there?
Leverage recapitalization is basically taking on a lot of new debt to fund a big cash dividend to shareholders. The theory is that by increasing leverage and giving that short-term stock boost with the dividend, the company becomes less attractive for a takeover.
So it's like using debt as a defense mechanism.
Exactly. And if key insiders keep their stock while the total shares decrease, their ownership stake goes up, giving them even more control.
Interesting. But it seems like a risky move, loading up on all that debt.
It is. It might pump up the stock price temporarily, but it also raises the debt-to-capital ratio and makes it harder to cover interest expenses. Exhibit 2.2, with the Sluggard Corporation example, shows this clearly. The market might eventually catch on and lower the price-earnings ratio to reflect that added risk.
So it's not a surefire win. The book then talks about equity valuation, comparing market capitalization with traditional accounting-based methods. What are the pros and cons of each?
Market capitalization is a practical way to estimate what economists call equity, the present value of future cash flows. But it's very sensitive to market sentiment, so it can be volatile in the short term. Traditional accounting, on the other hand, looks at things that have already happened, making it harder to accurately value those uncertain future earnings.
It's like comparing apples and oranges almost.
Right. And the economist's ideal measure of equity, it relies on data that's often subjective and hard to verify. Accountants love hard numbers, but those aren't always available when you're trying to predict the future.
And behavioral finance research, like that sudden drop in Intel's market cap that the book mentions, shows that market cap isn't always a perfect indicator of value.
Definitely. Behavioral finance suggests that market prices can be irrational. The Intel example shows that huge amounts of market value can disappear overnight, which might not reflect a real change in the company's long-term value.
It shows that markets can be driven by fear and emotion just as much as by logic.
Exactly. So as an analyst, you need to be flexible. Use the valuation method that makes sense for the situation rather than sticking to just one true number.
Right, it's about using the right tool for the job. The book then dives into the world of financial derivatives, which caused some surprises in the early 90s.
You know, it's interesting how derivatives started as a way to hedge against risks, like changes in interest rates or currency exchange rates. But then some companies started using them to speculate, basically trying to make money by betting on market movements. And when those bets went wrong, well, there were some big, very public losses. Companies like Procter & Gamble, Air Products and Chemicals, and Dell Computer all took hits, as the book explains.
It shows that even sophisticated financial instruments can be dangerous if used incorrectly.
Definitely. It was a costly reminder that derivatives can be a double-edged sword.
So back to the basics. The book then gives examples of a balance sheet using Lowe's and an income statement using Boston Beer. What are the key parts we should focus on when we look at these statements?
A balance sheet, like Lowe's in Exhibit 2.3, is a snapshot of what a company owns, its assets, what it owes, liabilities, and the owner's stake, shareholders' equity, at a specific time. Key assets include things like cash, inventory, receivables, and long-term assets like property and equipment. Liabilities include short-term and long-term obligations. The income statement, like Boston Beer's in Exhibit 3.2, shows how a company performed over a period, usually a year. It starts with the revenue, then subtracts costs to get to gross profit, then operating expenses are subtracted to get operating profit, and finally you get net income after interest and taxes.
Those are the building blocks, the foundation of all the other analysis we're talking about.
Exactly. But even within these seemingly simple statements, things can get manipulated. The book talks about Weirton Steel changing its depreciation method. How can a technical accounting choice like that actually affect the bottom line?
Yeah, it seems like something accountants would fuss over, but does it really matter that much?
It can. Weirton Steel switched from straight-line depreciation to a production variable method. This means they depreciated less when production was lower, which boosted their reported profits.
So they made themselves look more profitable without actually changing anything about their operations.
Exactly. It's a way to manipulate the numbers without changing the underlying reality.
Sneaky. Another way companies try to manage earnings is through extraordinary items. But as the book points out, some companies seem to have these supposedly rare events all the time.
Yeah, the definition of extraordinary is that it should be infrequent and unusual. But the book's research shows that many well-known companies, big names like Bell Atlantic, Fannie Mae, Sears Roebuck, were reporting these extraordinary items year after year. Makes you wonder if they're really that extraordinary.
It's like they're trying to normalize the abnormal.
Hmm.
And then there's the whole practice of companies encouraging analysts to ignore certain losses because they're non-recurring, unusual, or special charges.
Hmm.
And the book shows this is becoming more and more common.
Absolutely. These terms, they don't have any official definition under GAAP, but they're used to highlight things management wants you to ignore when you're looking at their earnings trend. They want you to focus on the good stuff and just forget about these one-time events.
It's like saying, pay no attention to the man behind the curtain. And the book uses Coca-Cola as an example, where they seem to rely on these out-of-the-ordinary items to meet their growth targets. One analyst even said management had absolute control over their earnings.
It's a powerful statement, and it shows how much these non-GAAP adjustments can distort the perception of a company's performance. When a big chunk of their earnings comes from discretionary items, like gains on asset sales, you have to wonder about the sustainability of their core business.
It's all about digging deeper and not taking those reported numbers at face value. This brings us to pro forma earnings and core net earnings, these unofficial measures that companies love to present. What's our role as analysts in deciphering these figures?
Companies, of course, want to show their results in the best possible light. So they use pro forma earnings and core net earnings, which often exclude things that are included in the official GAAP net income. While these press releases with these fancy numbers aren't bound by GAAP, it's crucial to understand how they're calculated and reconcile them back to the official numbers.
So don't be fooled by the shiny, happy numbers.
Exactly. And this divergence from GAAP, it even affects how overall corporate profits are reported. You have organizations like Standard & Poor's and Thomson Financial First Call, each with their own way of calculating operating earnings for the S&P 500.
So even at the aggregate level, there's this subjectivity in how profits are reported.
Right. These operating earnings figures often exclude things that don't have clear definitions under GAAP, and the methodologies used can differ significantly. Standard & Poor's tends to be more conservative than Wall Street analysts, as reflected in the First Call numbers. The Lowe's Corporation example in the book shows how different the reported profits can be depending on the method used.
It's a reminder that even widely reported numbers can be influenced by subjective choices. On a more positive note, the book mentions the end of pooling of interests accounting for mergers back in 2001. How did that change things?
That was a big change. Before, companies could use pooling of interests in certain mergers, which essentially combined the financials as if the companies had always been one. No need to recognize goodwill. But with mandatory purchase accounting, goodwill had to be recognized and initially amortized over time. While amortization was later dropped, companies still have to check if goodwill is impaired and write it down if necessary. This change has helped reduce discrepancies between pro forma and GAAP earnings.
So, a step towards greater transparency. The book also warns against relying solely on press releases, using the IDT case where their stock price reacted to incorrect numbers in a press release that were later corrected in SEC filings.
It's a great reminder to always go to the source. Press releases can be spun to sound positive and, as we saw, sometimes even have errors. Official SEC filings like the 10-K report are much more detailed and audited. Analysts who just read press releases risk basing their work on potentially wrong information. The IDT case also suggests that some managers might intentionally inflate numbers in press releases, hoping investors won't dig deeper.
It's like that old saying, trust but verify. Now, the book shifts to the difference between internal or organic growth and external growth through acquisitions. And it stresses that not all sales growth is created equal when it comes to increasing shareholder wealth.
Absolutely. High sales growth is great, but real sustainable value creation happens when that growth comes with improved profitability. Simply buying other companies and adding their sales that's external growth doesn't automatically create value if profitability doesn't improve.
So it's not just about getting bigger, it's about getting better.
Exactly. You need to be able to tell the difference between a company growing organically and a company that's just buying its way to growth.
Right. But the book does say that external growth can sometimes lead to higher profitability through things like economies of scale and economies of scope. Can you give us an example of how that works?
Sure. Economies of scale happen when a bigger company gets better deals from suppliers because they're buying in bulk, reducing their costs. Economies of scope are about combining related businesses and using resources more efficiently. The book gives the example of a potato chip company buying a pretzel company. By using the chip company's sales force and distribution network for pretzels, they can cut costs and boost profitability.
So it's about finding those synergies between businesses. To understand the link between sales volume and profitability, the book uses break-even analysis with the fictional Central Widget Company in Exhibit 3.7. What insights can analysts gain from that?
Break-even analysis shows you the minimum sales a company needs to cover its fixed costs. In Central Widget's case, they need to sell 200 million units to break even. After that, each additional unit adds to profit. By estimating fixed and variable costs, analysts can see how sensitive profits are to changes in sales and capacity utilization. Exhibit 3.8, with the West Coast What's It example, shows this relationship between sales and pre-tax income over several years.
So it helps you understand the company's operating leverage.
Right. But the book cautions us about just accepting company-provided percentages for cost of goods sold, COGS, and selling, general and administrative SG&A expenses, because those figures are based on the company's own sales forecasts.
So their cost projections are inherently biased towards their own optimism, right?
Exactly. If you, as an analyst, have a different view on sales, you need to adjust those cost percentages accordingly. Otherwise, you're just accepting their potentially rosy sales projections.
Right. It's about maintaining that independent perspective. The book also discusses the impact of seasonality on cost of sales, using Six Flags in Exhibit 3.9 and contrasting it with Washington Group International in Exhibit 3.9. What's the key difference there?
Six Flags, being an amusement park, has a very seasonal business. Most of their revenue comes in the warmer months. This causes big swings in their cost of sales as a percentage of revenue throughout the year. You need to be aware of this seasonality to compare performance across different periods and make accurate forecasts. Washington Group International, on the other hand, is an engineering and construction company. Their costs are more directly tied to the projects they're working on, so their costs are more variable, not as affected by the calendar.
Interesting how different industries have such different cost structures. The book also talks about how acquisitions can artificially boost earnings per share, especially when the acquirer has a higher PE ratio than the target, like in the big time and small change example. But it also warns against the dangers of conglomerate mergers and relying solely on acquisitions to grow EPS.
The big time small change case shows how a company with a high PE can buy a company with a lower PE, and just by combining their financials, their EPS goes up, even without any real improvement from the merger. But this strategy, which was big in the 60s with all those conglomerates, often doesn't work in the long run. Integrating very different businesses is tough, and competition for acquisitions can narrow that PE gap. Eventually, the acquirer's own growth might slow down, making it harder to keep boosting EPS through acquisitions.
So it's not a sustainable strategy forever. What should analysts do when looking at companies that rely heavily on acquisitions?
It's about digging deep and separating the organic growth from the acquisition-driven growth. Look at SEC filings and media reports to understand the terms of those acquisitions, even for private companies. This helps you assess whether they're creating real value through synergies or just building an empire without improving profitability.
It's about understanding the quality of that growth, not just the quantity. Now let's talk about the statement of cash flows, which the book says is crucial for understanding a company's liquidity, especially in leveraged buyouts, LBOs.
The statement of cash flows shows the actual cash coming in and going out. In an LBO, where a company is bought with a ton of borrowed money, this statement becomes super important. It shows if the company can generate enough cash to service that debt, cover expenses, and stay afloat. The LBO example in the book shows how cash flow is basically sales minus cash expenses, highlighting that depreciation is a non-cash expense.
Right, so it's about the real cash, not just the accounting profits.
Exactly. And the book emphasizes the risk of LBOs because of that high debt. Exhibit 4.3 shows how even small misses in projections can lead to negative cash flow.
So those LBOs, they're really walking a tightrope.
They are. Because the interest expense is fixed, any shortfall in sales or increase in costs can quickly eat into their cash and their ability to make debt payments. The statement of cash flows is essential for seeing that risk clearly.
Beyond LBOs, the book also highlights this statement as the most important one to look at when analyzing a troubled company that might be heading towards bankruptcy. Why is that?
When a company is in trouble, the balance sheet might overstate the value of its assets because they haven't taken the necessary write-downs. Or it might not show the real cash they could get from selling assets. The income statement, focusing on past profits, becomes less relevant when survival is the priority. The cash flow statement, however, answers the most important question. Can they generate enough cash to pay their bills and keep operating in the short term?
So in a crisis, cash is king.
Absolutely. The book then connects cash flow patterns to the company life cycle, noting the different risks at each stage. It gives examples of cash flows from operating, investing, and financing activities, and then presents two contrasting cases. Polaroid, a declining company in Exhibit 4.8, and Walmart, a high-growth company in Exhibit 4.9. What jumps out at you when you compare their cash flow patterns?
I'm ready to compare and contrast. What are the key differences?
Polaroid, in a declining industry, struggled to generate enough cash from operations because sales and profits were shrinking. This forced them to sell assets or cut capital spending just to meet their obligations. Walmart, on the other hand, was a cash-generating machine. This allowed them to fund their expansion without relying heavily on borrowing or issuing stock, giving them huge financial flexibility.
So strong cash flow can be a real competitive advantage. The book also introduces this idea of the free cash flow theory, which suggests that companies should pay out excess cash as dividends instead of hoarding it for potentially low-return projects. The threat of hostile takeovers is mentioned as a way to keep management in check.
It's an interesting theory. It basically says, if you're not using that cash wisely, we'll take it and give it back to the shareholders who can invest it elsewhere.
Right, it's about making sure management is using capital efficiently.
Mm.
Now let's talk about profit. It seems simple. Revenue minus costs. But the book argues that this simple formula isn't enough because recognizing revenue and costs can be subjective.
Exactly. The timing of when you recognize revenue and costs can significantly affect reported profits. The book differentiates between bona fide profits, a real increase in wealth, and accounting profits, which are just defined by the rules.
So you're saying you can have accounting profits without actually creating any real value.
Right. The Salsa International example in Exhibit 5.1 shows how transactions can create revenue on paper without actually increasing wealth.
It's all about understanding the substance of those transactions.
Exactly. The book also mentions an early analyst who advocated for focusing on earnings before depreciation and even adjusting depreciation estimates because they can be manipulated.
Depreciation, that's another area where things can get tricky.
It is. Think about real estate. You can have an accounting loss from depreciation, but the property value is actually going up.
So you're losing money on paper, but gaining wealth in reality.
Right. Some capital-intensive companies might try to mislead you by saying you should ignore depreciation to make them look profitable.
But we know better than that now.
Exactly. So this simple profit formula, it's not enough. Accounting profits can be totally disconnected from real investor returns, as we see with real estate and LBOs.
It's a reminder to always look beyond the surface. The book then dives into revenue recognition, warning us not to take reported revenues at face value, even if they're audited. Why is that?
Because companies can get very aggressive with how they recognize revenue. And sometimes it even crosses the line into outright fraud. Rapid sales growth can be a red flag for potential revenue revisions, like in the Informix example.
So fast growth isn't always a good thing.
It can be a warning sign. The Informix case, where their auditor, Ernst & Young, failed to catch the misleading revenue figures, shows that even audits aren't foolproof.
So even with an audit, we still need to be skeptical.
Absolutely. The KnowledgeWare example shows how gaps between revenues and receivables can signal problems, even when companies try to downplay them. There are many other examples of improper revenue recognition, like Kendall Square, Walmart changing how they accounted for layaway sales, BJ's Wholesale Club with their membership fee recognition, Bausch & Lomb with channel stuffing.
It's a reminder that there are many ways to manipulate revenue.
Right. And Professor Michael C. Jensen, who the book cites, points out that using budget targets in compensation formulas can incentivize revenue manipulation.
So there's often a financial incentive to fudge the numbers.
Unfortunately, yes. And the book stresses that overly aggressive revenue recognition, even if it's not initially fraud, can be damaging, and analysts need to react quickly when they see evidence of it.
It's about staying vigilant and not giving companies the benefit of the doubt when it comes to revenue. The book then talks about how companies might strategically classify gains, like IBM did with the sale of their global network, to boost operating income, which investors value more.
It's another way to make the numbers look better. And then there's the Wix plant scandal, a clear case of deliberate profit overstatement. The consequences were severe. Management had to repay bonuses, people were fired, and there were even criminal charges.
It shows that playing fast and loose with the numbers can have real consequences.
Absolutely. And it reinforces the need to be skeptical, especially with companies that are already in trouble.
Now let's discuss EBITDA, earnings before interest, taxes, depreciation, and amortization. The book highlights its limitations in connecting net income to total enterprise value, using the Deep Hawk and breathing room example in Exhibit 8.1.
EBITDA is often seen as synonymous with cash flow or operating cash flow, which is important because cash flow is linked to bankruptcy risk. The book mentions a 1966 study by William H. Beaver that found financial ratios, including a common definition of cash flow, to be good predictors of bankruptcy.
So cash flow is a key indicator of financial health.
It is. But the problem with EBITDA is that it doesn't account for crucial things like capital expenditures, which are needed to maintain and grow the business.
So a company with high EBITDA might still be in trouble if they're not investing enough in their future.
Exactly. And this desire for stable and predictable earnings has led to the popularity of alternative profit measures like operating earnings, EBIT, and EBITDA. They're seen as less volatile, and the market often rewards stability. We even saw earnings before expenses, EBE, during the tech boom, which was pretty extreme.
It's like they were trying to invent new ways to ignore costs. And the book brings up the case of Chainsaw Al Dunlap and Sunbeam, where even external audits and corporate disclosures didn't guarantee reliable financials.
The Sunbeam case is a stark reminder that we can't just blindly trust what companies tell us, even if it's audited. Due to limited or misleading disclosures and the nature of audits, which are often negotiated, you have to be your own watchdog and scrutinize those financials carefully.
So it's about taking responsibility for your own due diligence.
Exactly. The book also touches on the political lobbying around pooling of interests accounting for mergers, showing the influence companies can have on accounting rules. Exhibit 10.1 shows how much money was spent on lobbying efforts related to this issue. And then there's the Navigant Consulting example, where they pushed the limits with their merger accounting and ended up restating their earnings.
So companies are always looking for ways to game the system.
It seems that way. And the takeaway is that they'll continue to find new ways to disguise the impact of mergers, and analysts need to study those past tricks to be prepared for new ones.
It's a constant cat and mouse game.